Hello, my YouTube friends. My name is Adam Kahn, and this is Dividend Retirement. Hope everybody's having a good Wednesday. Today, I'm going to use ChatGPT to do an analysis on a few stocks that I've added to my dividend portfolio as I go on this rotation. I really appreciate you guys joining me. For those who aren't familiar, part of why I call it Dividend Retirement is I'm slowly rotating over the next 3 to 5 years out of some of the growth stocks, primarily using covered calls to sell those shares and rotate into dividend stocks as I move into retirement and preparing my family to make life easier on them. So stick around. Today should be a great video. So the first stock that I'm going to analyze, and to be fair, I haven't even read through it yet. I'm going to do it with you guys. I'm just going to read what it's given me, and to show how simple it is to use. But the first stock I'm looking at is MTN, which I think of as Mountain, but it's Vail Resorts. And MTN owns something like 41, if not 42, different ski resorts across the country and out of the country, if I remember correctly. But they also have restaurants and lodging and other things. I really like it because my son likes snowboarding, and if I can, we played hooky the other day. I'm going to try to put a little video of
Oh,
him
there he goes.
doing a little snowboarding because proud papa. I always love doing stuff with my son. But either way, it kind of is a niche thing that makes it fun for me to invest. I know that sounds stupid because the real goal is to try to make money and do well, but it pays a 6% dividend currently. The stock got beat up really badly. Possibly it could be a seasonal trade, but on top of the fact that it was like we didn't have a whole lot of snow going into the holidays, and I'm guessing that hurt ticket sales and other things, and I think that people probably overreacted because I'm guessing that Vail and their 42 ski resorts are pretty used to ups and downs and not being able to predict what the weather patterns are. Now, that being said, I didn't delve into it super deeply. I just looked briefly at some of the finances. Maybe they've taken on too much debt or done some other things to put the company in jeopardy. And it isn't a huge company, so I guess we'll see what ChatGPT says. And so you know how easy it is. All I put in is, let me read it. Like I said, I'm just going to read through this. But create a description on if MTN stock is a good investment currently. So it's kind of helping everybody. I hope you understand part of why I'm explaining that is if you want to do research on any stock, these AI models are really good for information. Now keep in mind, like anything, they're not always accurate about some of the information and they make mistakes. I would still do your own research and dig into it for your own investments, which little asterisk. As always, nothing in these videos are financial advice. Please don't listen to me, and I really don't think you should be listening to YouTubers when making financial decisions. You have to do your own research. I am not a professional financial advisor, so I suggest reaching out to one when making your decisions and not following me simply because I stated something on YouTube. Now, I say that partially because everybody needs to individualize their investments. If you meet with a professional financial advisor, my thought is their first question should be something along the lines like, what's the goal with your investment? And don't presume that's just a stupid question because it isn't. You really need to figure out what your goal is with your investments. How old you are. Are you just shooting for the moon and you don't care if it goes to 1 million or zero? Or are you looking for something slow and steady to grow over time? Like you have to make all those decisions before just blindly buying stuff for the sake of buying it. Anyway, let's see what it has to say. So, company and market position. MTN Group is America's large. Oh, hold on a second. Like I said, it already made an error. So let's see if they're talking about the wrong company. They're talking about some African company. I told you I'm just doing this with you. Um, Let me change it so that it reads properly and that I call it Vail Resorts and update it. So MTN, comma Vail Resort stock is a good investment. Let's see if it gets it right. as I start reading it. I told you I hadn't done it beforehand because I thought you'd see with me if it was good. So, good example of an error. It's talking about some telecom digital services in Africa. Give me a second. I'm going to hit pause, see what I need to put in to get the proper one in. Okay, it didn't take too long. All I did was reverse the name of the company with the ticker symbol, so I changed it to, create a description on if Vail Resort stock, ticker symbol MTN in America, is a good investment right now. So, like I said, we see errors, but let's see what it has to say. So, business overview. Vail Resorts Inc. operates one of the world's largest network of ski resorts and mountain experiences. Its revenue primarily comes from lift ticket, season passes like the Epic Pass, lodging, food and beverage, and ancillary services. The business is high seasonal and weather dependent, with much of revenue concentrated in winter months and additional summer and year-round activities at certain properties. This unique model gives the stock exposure to both leisure, tourism, and discretionary consumer spending. Recent financial and operational performance, recent earnings and guidance. Vail has reported better than expected quarterly results at times, with solid revenue growth and incremental profit gains, but the company still experiences seasonal losses in off-peak quarters as expected given its business model. For fiscal 2025, the company posted revenue increases and a rise in net income compared with the prior year. Vail reaffirmed its 2026 guidance, projecting a net income range and EBITDA levels that suggest modest growth, emphasizing continued investment into capital projects and guest experience improvements. An ongoing resource efficiency transformation plan aims to reduce costs and improve profitability. So, all sounds fine with me. Analyst rating and price targets. Consensus outlooks. Analysts are mixed, which I already knew that. Some ratings are hold based on average opinion, while several firms assign buy ratings. The 12-month average price target amongst analysts of early 2026 is roughly $173 to $178, implying 25 to 28% upside from typical recent share prices in the low to mid 140s. Today it's below 140. And that's kind of funny. That's one of the things I really like about Vail Resorts. Forgive me for skipping a bit. Like, I kind of value it the same way, somewhere between $170 to $180 a share. And right now it's trading at 140, and I don't need to hit things out of the park. And it's paying a 6% plus dividend yield. So, me rotating into dividends, if it's able to continue paying that dividend over the next 10 or 20 years, I'm not super concerned if the stock price really appreciates over time. That makes things nicer, and I hope so. But again, I thought it was kind of a niche spot. I'll keep reading. So let's go. Upgrades. Jefferies upgraded Vail to a buy, pointing to upside potential from strategic shifts and pricing strategies and forecasting future revenue and skier attendance growth. Previously, upgrades from JP Morgan and others also highlighted a relatively favorable risk reward at certain price levels, though these were more neutral than outright bullish because they think it's getting cheap. Kind of where my head was, and I don't think too many people pay attention to Vail Resorts or MTN because if you're Bill Ackman, I just use his name because it always pops in my head, or Warren Buffett, but somebody who manages billions of dollars, you really can't invest in companies that are too small because it just doesn't make sense. It doesn't drive the needle in your portfolio. So sometimes I think there's really good opportunity in some of the smaller companies. Um, Despite these positive hold rating dominant consensus suggesting analysts see value, but also factors that warrant caution. So, for dividend and capital returns, Vail offers a dividend yield that has been attractive, plus or minus 6%, which can be appealing for some income oriented investors. However, dividend sustainability is a consideration. Recent payout ratios suggest dividends could be stretched relative to earnings, especially in weaker seasons, which, Of course, that is something to be cautious of and concerned about. Uh, I know they're pushing it. I don't put a lot into any one company, and again, not financial advice, but I don't suggest anybody put too much into one company and get hyper focused. I think we are the last to have the information, and on top of that, the information that we do have isn't always the greatest. Whereas some of these guys are in the mesh with the CEOs and the other, they're just going to have more information than we do when they're making their bets. I plan to have somewhere between 30 and 40 different holdings in my account to hit my goal with my dividends. So weather and seasonality. Now this is the part I think is kind of funny because Vail's been in business for an awfully long time. And I'm quite sure that they're used to seasons where the snow doesn't come for a while and vice versa. And I'm sure it impacts their earnings. And I'm also sure that they're used to that, so it isn't a major deal. I suppose if it was bad for 5 years, that's one thing. But at least here in Vegas, we even got snow on the mountain. I know that Utah did. I assume that all of their ski places was getting snow recently, even though it didn't come early this year. Um, so Vail's performance is highly correlated with snowfall and weather conditions. Poor snow seasons reduce ski visits and lift ticket revenue, a major risk for earnings volatility. Recent reporting indicated lower skier visits due to snow shortages, which impacted revenue and sentiment. So they're already aware, so to me it's priced in. And I get it, it was the holidays. Maybe it hurt for this season, but I'm not super worried about the next few years. Consumer discretionary demand. As a discretionary leisure play, Vail is sensitive to economic slowdowns. Consumers may cut travel or seasonal leisure spending under financial stress. Now, this is what I like about Vail. If anybody who's been watching the news is pretty aware, I assume, that the top 10% are the ones still driving the economy. Skiing and snowboarding are very expensive sports. I have a feeling that the people that are doing that aren't quite as impacted by the ups and downs of the economy, despite the sensitivity for leisure and that type of investment. So I personally think the analysts are oversensitive to this. I absolutely could be wrong. Maybe they cut back their skiing and snowboarding too, but I think it's a sport that generally the wealthy do, and I don't know that they're going to not go because the economy slows down. Guidance and growth moderation. Some analysts point to modest growth projections and flat or slightly improved EBITDA forecast for fiscal 2026, indicating the company may not grow quickly in the near term despite valuation support like dividend price targets. I agree. Mixed analyst views. Research from some sources suggests slow growth and potentially disappointing guidance are reflected in cautious valuations, implying the stock may be priced for modest performance rather than strong expansion. Great. Six, investment. Well, you don't need to know it's number six, but they put it up as number six. Investment thesis summary. Bullish points. Analyst price targets suggest upside, roughly 25 to 28% potential upside in consensus targets. Strong brand and premium assets. Vail's portfolio of premier resorts has pricing power and high entry barriers. Agreed. Dividend yield, attractive yield could provide total returns even if price appreciation is modest. That's what I like. Cost improvement initiatives, transformation plans aimed at improving efficiency and margins. I assume they're doing that all the time. I don't know that that's something to call a bullish point, but maybe it is. Maybe they have something specific. Bearish and cautionary points. Seasonality and weather risks, which I talked about, but earnings can swing materially based on snow conditions. Mixed analyst ratings. Look, I think the analysts are a bunch of monkeys, so that doesn't bother me either. Consensus leans towards hold rather than strong buy. I find the analysts raise price targets when stocks are going higher and lower them when stocks are going lower. So I'm not sure that they do anything but follow the direction of the market. I'm sure some of them are excellent. I don't want to make fun of all of them. But for the most part, like when I was on the floor of the exchange, I worked for Sanwa Bank. And I was put in charge of putting out our analysts on the currency when I was on the currency markets when I was brand new. The reason was it got passed down to the guy because they didn't want to do it, the people who'd been doing this for years. I was super new and inexperienced writing the blog that went out to all the people that we were sending out the information on the trades for the currencies. And I have that's why I don't respect the analysts. Like, my guess is the guys who really know are not the ones putting out these papers and making the predictions. They're the ones managing the money and dealing with what to actually invest in. And the guy who's new is the one who's the analyst because nobody wants to do that stuff. It's boring. Maybe I'm wrong, but that's why I don't respect a lot of them, and they seem to be wrong all the time. So, anyway, let me continue. Dividend sustainability, a high payout ratio, raises some concerns about long term dividend stability. I talked about another stock recently, which was Robert Half, that I think they may have to cut the dividend, but it was so high that if they cut it in half, it's still an attractive dividend. It's 6%, even if they cut it in half and I was getting 3%, if they're able to do that, it's still okay. I don't have any concern, but that's me personally, which is why you need to do your own research. Moderate growth outlook, near term growth projections are not robust, implying reliance on share price multiple expansions and operational improvements. Bottom line, number 7, is MTN a good investment right now? For long-term investors, Vail Resorts has structural advantages: premium resort, networking, pricing power, and dividend yield. It may appeal if you believe in leisure, travel growth, and resilient post-pandemic discretionary spending. For short-term or risk-averse investors, the company's weather-dependent seasonal volatility and mixed analyst sentiment suggest caution. Returns could lag if macro or operational headwinds intensify. Overall, the stock is not a clear near-term buy, according to the average analyst, but it can be strategic hold or selective accumulation for investors willing to endure cyclical swings and focus on total return, dividends, and modest price upside. If you want, I can, and then it gives you an option to compare bull versus bear and some other stuff at the end. So I really enjoy the AI stuff. I like the information, how it consolidates it and makes it pretty easy to understand. In terms of MTN, I would say it's neither one way or another. I like the investment. Me personally, I'm totally content that where I bought it, and I'm selling some calls against it to even increase that return a little bit on some of the shares that I bought. But I don't know. I guess we'll see as time goes on. The other thing that I like about Vail Resorts is I'm actually trying to find companies that are not sensitive to AI. Like, everything might be sensitive to AI in time, and maybe we should all be gloom and doom and everybody's going to be out of a job and nobody has any money. Like, I suppose anything is possible, but I also feel like if I were to use video games as a timeline, because it was what my brother and I were using, we are in the Pong version of AI. And as impressive as it is, I don't even think we've hit Atari. So until we get into like Xbox and the things of today, I don't think companies like Vail, that does ski resorts, is really in jeopardy of their business model being impacted too much, other than improving it for now. I don't really see them being totally disrupted and ski instructors being out of a job, because it's still something people like to do. In fact, if anything, I think it's more likely to do better unless people just have no money because there's no opportunity to earn a living. So I'm trying to find companies like that pay dividends. It's why I like Conagra, which is the one I'll do next, and some of the others I've been looking at. Now, again, I just put it in. I haven't read through the thing about Conagra yet. I'll give you a quick synopsis of my thoughts. I assume it's going to be a pretty similar type of comment on it where ChatGPT doesn't necessarily love it or hate it. What I really love about Conagra is it pays an exceptional dividend. On top of that, I do not really see AI disrupting the consumer staples divisions. And maybe in a long time they will, and maybe we just have a few companies that own everything. But I'm not worried about that, and I think we would see that coming down the line. But they're in a position where they're capable of paying their dividend. It didn't really look like it for a while because they had some expenses that they were writing off. But the reality is they have enough money coming in to pay a very healthy dividend. They do have a little bit more than that to continue to expand. The negatives that I've seen when I've looked at it are that companies like Walmart and Amazon are trying to give more shelf space to their own brands. Now, it's possible that Conagra or similar, like Kraft Heinz, are the ones actually making the brands that Walmart are selling. But they're trying to give less shelf space to the Conagra brands and more to Great Value. But people like what they like. You can do that all you want. And unless you just eliminate it because you've decided, forget it, we're going to stop carrying it, which is a possibility. I would be cautious of that. Again, not financial advice on why I don't put tons of money into one stock. But but I don't really think people are going to stop buying the brands that they want. I think that they might be price conscious and try other things. But if they like the ones they like and it's not that much more expensive, they'll go back to it. So here we go. Number one, what Conagra does in market position. Conagra is a major U.S. packaged foods company with well-known consumer brands including Birds Eye, Duncan Hines, Ready Whip, Slim Jim, and Healthy Choice. Its products span frozen meals, snacks, and refrigerated foods, making it part of the consumer staple sector, which typically performs stably in various economic environments. Now, it's also really dropped a ton over the past few years, so I like that as well. What I find is with these types of companies, and probably includes Pfizer and some of the others, they might trend in a direction for a very long time. And people get really like dissatisfied for them when they're doing poorly because it's slow and methodical and painful and just really sucks. But eventually it gets to such a good valuation that somebody's willing to pick it up. And once it reverses, I find the same thing the other way. It's slow and methodical and boring and it doesn't go straight up. So you really have to stick with these things for a long time. Not financial advice, but that's what I like about Conagra. I love that dividend. And if I can pick up something paying over 7% that over the next 5 or 10 years just slowly drifts higher while nobody pays attention to it, that is hitting it out of the ballpark for me because I don't need whoa, whoa, whoa. Those roller coasters are no fun to me. And to be fair, I make bets on those roller coasters, but they are so small that I don't pay attention or worry about them because if they hit, all of a sudden they turn into something attractive, but I'm not going to put in an amount of money that makes any difference one way or another. So, because its products are everyday good, Conagra is often seen as a defensive stock. Sales tend to be more resilient than in cyclicals if economy slows. That said, growth in the sector is usually modest rather than explosive, like super boring. I would agree. So, recent performance, number two, and outlook. Guidance and sales trends. The company reaffirmed its fiscal 2026 forecasting organic net sales to be flat or increase slightly, range roughly -1% to +1%. Adjusted operating margins are expected around 11 to 11.5%, with earnings per share of about $1.70 to $1.85 according to tip ranks. Now, their dividend is $1.40, which is why I said fits in just fine with their earnings. Conagra also forecasts improved free cash flow conversion, plus or minus 100% from 2024 2026, indicating stronger cash generation relative to earnings, a positive sign for dividend sustainability. However, sales growth remains muted and revenue expansions are modest at best, mirroring broader pressures in packaged food segment. Boring industry. Macroeconomic and cost pressures. Persistent inflation, which, you know what, pay attention to those tariffs. I know that they've been implemented again, but that could affect their margins. Rising import costs, especially tariffs and protein prices, and challenges in consumer demand have pressed margins and slowed growth. Earlier profit forecasts were revised below Wall Street expectations due to these headwinds. So I'm guessing the tariffs have impacted them. And the funny thing is since the not the Department of Justice, since the Supreme Court has deemed those some of them not constitutional, it is possible that they could be included as some of the companies that actually get refunded for what they were charged. And just off topic, I think that's so stupid. Like, why would the companies that have passed through the higher prices get a refund on what the tariffs cost versus the consumer who's actually paid for these? Like, hello, I could understand actually not making them unconstitutional, but the government shouldn't have to pay back the companies. Like, they've changed their prices accordingly. And the funny thing is if they can't tariff going further, that's just going to give better margins to these companies. They're not going to lower the prices to make it better for you and I. They're just going to make more money. Anyway, just it's all nuts if you really ask me. So, number three, valuation and analyst consensus, Wall Street View. According to recent data, analyst consensus on Conagra is hold with a typical 12-month price target slightly below or near current price. And they're saying around 19. When I looked today, it was like $18.40. One widely referenced estimate suggests the average price target is around 19, implying minimal upside. So, I got to tell you, if in 2 years it's at 19 and I got my 7% and change dividend, woo, that's good. And I know that sounds silly because the market might have done 15 or 20%. But I don't need to do what the market is. I'm fine underperforming. My goal is to not have to be in the position if there's a correction one year that I have to decide what I'm going to sell to be able to generate the money that our family's going to live on. And I don't want to put that on my wife one day when I get hit by a bus. Uh, Price targets range anywhere from a high of $22 and as low as $16, indicating no strong conviction or robust rally, anything either direction. And that's the range I've noticed it trading in, so it makes perfect sense. Valuation metrics. Conagra trades at low valuation multiples compared with historical levels and peers. That's what I like. And I talked about this in another video. If we get into a situation where the economy slows and rates go lower and you get less from investing in CDs and things like that, these are the stocks that I think you'll see PE expansion because people will want to find revenue in other things outside of those fixed income options. So they'll look towards dividend paying stocks. And if Conagra gets in a position where it can pay out that dividend, people will be attracted to it. This supports view as evidence it may be undervalued. However, valuation alone doesn't guarantee future gains, especially if sales growth stays weak. Dividend profile. This is number 4. Key consideration for many investors. One of Conagra's standout features currently is its very high dividend yield, often cited above 7%, making it one of the highest yields in the S&P. Pros of dividend. A high yield can provide steady income, especially appealing in low growth markets. If the dividend remains stable, total returns can be boosted even if share price growth is slow. And I don't think that's what will happen. I think if things are stagnant, if rates come down, like I just said, I think you'll see prices of companies like Conagra drift higher without their sales doing any better. And people will be like, what is that happening? And answer is because I can't get that type of return anywhere else. So potential concerns, the dividend payout ratio and cash requirements of the dividend are relatively high versus historical averages, which investors watch for sustainability. But it's not really in jeopardy. That's overly cautious to me. Key risks and headwinds. Number 5, consumer and cost pressures. Conagra has struggled with inflation and tariff-related cost increases, pressuring margins and prompting guidance cuts in the past. Weak consumer sentiment, especially for packaged food. can directly affect volume and growth sales. I get it. Growth challenges. The company's organic sales growth outlook is modest at best, meaning upside from core business expansion is limited unless new drivers emerge. So, unless they come up with some new products, not really doing anything exciting. Defensive nature. As a consumer staple name, Conagra often behaves defensively in downturns, but doesn't typically deliver strong performance in high growth environments. I think that is absolutely correct. Number 6, investment thesis summary. Bullish points, high dividend yield. That's what I like about it, so it makes sense to me. Strong cash flow generation, improved guidance suggests operational stability. So I love that. Strong cash flow. Whoop, that I'm repeating the same thing. Look at that. Valuation metrics look relatively inexpensive versus historical norms. Cautionary points. Limited revenue growth. Yeah, that's nothing I'm concerned about. And muted sales outlook, reduced prospects for significant capital appreciation, macro pressure. So inflation and tariffs continue to affect profitability and cost structure. And if they get worse, they'll get worse. Analyst consensus predominantly hold, with price targets suggesting little near-term upside. The bottom line, number 7, is Conagra a good investment now? For income-oriented or defensive investors, Conagra may be attractive due to its high dividend yield and consistent cash generation, providing income and downside protection in more volatile markets. For growth investors, the stock is less compelling because organic growth forecasts are modest, and analysts do not see significant short-term price appreciation. Overall, Conagra is a defensive income-focused stock that may fit a portfolio seeking yield and stability, but is not a strong growth play right now. So to me, that makes perfect sense. Again, I really like the information that these AIs help with. It's a really good, quick analysis on anything that you want to look at. I would suggest playing with it with the stocks that you look at. And for me, stocks like Conagra and Mountain are well balanced, like rounding out my account. The 4 biggest holdings, well, 4 of the 5 biggest holdings are Meta, Amazon, Google. I'm missing one. I know Chevron's one of them. That was one of the ones that it's like, it's a little bit in this other group of stocks, but they're the super, Mag 7 type of companies that are big growth and everything else. And I love those companies too, but I'm trying to balance out a bit as those have had such a great run over the past 4 years. There's just no reason to be overly invested in them. Now, as a side note, in my trading account, so there's full disclosure, I watched a video by Chris. I know his last name begins with a C. He's a guy who turned like 20 grand into $80 million, sort of, over 18 years. You can look him up. Canelo or something like that. I'd have to look him up again. But I talked about that as well, and I put a good trade on for Amazon. I bought a little bit of Meta the other day as well. I think they are both very attractive in price, and I thought he made a really good case as to why Amazon, through this AI, whatever you want to call it, has real potential to really double or triple over the next few years. And I think, and I already like Amazon. It's one of my biggest conviction stocks. So to put it on as a trade is no big deal for me since I like it already. Anyway, I'm really glad that some of you showed up yesterday for Tuesday's live. It is so much fun for me. I'm sorry I had to keep it short, but my son didn't have school. So we kind of played hooky on Monday. It was a weird week. Had school Monday, but no school Tuesday because they were doing testing for the juniors and whatever. I don't try to figure it out. But either way, I kind of cut it short. Next week, hopefully, you guys can make it again. I love that platform. It's kind of fun for me. I really appreciate you checking out the new channel a bit. If you could do me a favor, hit that subscribe button, smash the like button, make some comments. And really, I'm not super concerned if you hit those buttons, but make some comments. I like the interaction, as I stated in the live, and I'm going to try to talk about it more. I am not super concerned if the channel does all that great. I kind of like the small and getting to know some of the people and the thought process and the things that you're invested into, especially as I'm, transferring into dividend stuff, because some of you watch that more closely than me. And a few of you have reminded me of ones that kind of fit that portfolio. Like Hess Midstream, I picked up a little, as well as MLPA. And the funny thing is, they're in the trading account just because I put cash on the sideline, but I do kind of wait in case there's a big correction. I am not buying the falling knife stuff. I've decided to just step out of the way and back off of it because Google. Okay, one of the things that Chris Canello was it? It's driving me nuts. Forgive me for a second. Let me see because I looked the other day. Chris Camillo. So he talked about Google a bit, and it was very interesting because Ben Reitzes had talked about it back when the stock was trading near the lows about how as AI continues to come around, like Google's going to be in jeopardy of search, which I think is probably true. And search is like 50 to 60% of their revenue. Now, Google has some incredible engineers, and Gemini is doing exceptional, and maybe they end up being the one. I just don't want to make that bet, and that's what's made the stock reverse and start going great straight up. If I didn't mention it, Google's my other one. I don't know if I did or not. So I'm getting more aggressive on the calls that I'm selling on Google. And it's not that I don't believe in Google, it's that I worry he's right and that they're going to lose a large percentage of their current revenue. It may transition to their Gemini side of things, and it may be that they're doing some incredible things in healthcare and all sorts of stuff that they might become a new behemoth. And based on their size already, they're able to make some massive investments. But I want to rotate. Anyway, we won't get into all that. Thanks for stopping by. If you can come on Tuesday, it's Tuesday at 11 o'clock Pacific time. I really do appreciate that. Make the comments in the comment section. I try to respond to everybody. The only thing I ask is be respectful. Feel free to disagree with me. Like, nothing offends me. But there was one guy just yapping and screaming and whatever that it was like enough's enough. I don't. It's a distraction. So have a great day. I hope your portfolios are reaching new highs or doing really well. And talk to you guys soon. Bye bye.